Wanted to go over a deal with you guys that we actually were on. We're working on this deal. I didn't go after, we went after the deal, but my discipline kept me out of the deal because at the time when it came to market, it was brought to market by a big institution and some other institutional players were after it. We were a little bit shy of where the offers came in. Then they pulled the deal. I didn't follow up on that deal. It stayed on my list. And an actual big company actually bought it, a big institutional investor, one of the largest multifamily owners in the United States bought it. But I wanted to show you how this deal worked because my numbers were right. And again, I share this with you guys, whether you're going to invest with me, do this on your own. I want you to see what I'm looking at. So if you decide to invest with us at any point, you get it. If you decide to do this on your own, I want you to see what bigger investors, when they're thinking through a deal, how does the money work? I want you to see how they do that. And I simplify it. Again, I got people that I work with. We have different models that we run up and down, but this is my decision of how I'm looking at a deal, like the money. All right. So this specific deal, I'll go with what it traded at. I was actually probably $1 million higher at the time. They wanted probably about they wanted 122 million at the time. I was about 117. This thing traded at 116. So we'll start with 116. This is where this group traded it. I can talk about the deal now. Um, as you guys notice, when I'm working a deal, I don't talk about the deal as much because you can't just be like, hey, I can't, you can, but that's not how it's done. When you're looking at some of these bigger deals, there's a level of confidentiality. So I'm not going to be going through a whole bunch of details about the deals, but I can do it now because the deal traded. So before, only my internal network saw this deal and we talked about it, and I used it to say, hey guys, this is a deal that was quality that we went after. And this is the deal we worked. This is the deal I made an offer on, but here's where we are. So the deal traded at 116 million. So this deal, because I know the group, I know them very specifically. They own 31,000 units. They're a big major player. So I know their model. Most of these guys are institutional investors. They have the same model over and over again. So here's what happened. Guaranteed, and this is how we did it too, 40% down. 40% down on 116 million is 46 million 400. Boom. That's what they had to put down. So when you take a look at these numbers on the average, this is how I looked at it. So we were going to be putting down, if we all collectively came together, we're like, hey, look, because the bank's going to finance the other. We're not the bank, but Fannie Mae, Freddie Mac, life insurance company, a debt fund, Wall Street, all of these things are going to fund the 60% on the average. Now, I'm sure on this deal, they probably put down 35%, 37%. But when you underwrite a deal, you underwrite it simply, back of napkin, simple math. So 40% down. This is what we're doing. But if we were to go 46 4, boom, times 5%, because that's what you're expecting on these deals. Every time I'm looking at a deal, can we get 5% return on our money? Boom. Without doing anything, at some point, year one, year two, are we going to hit 5%? Even year three sometimes, because it depends on the deal. This deal would have hit 5% in year one, right? We already knew that because there's some discrepancies. This is a brand new property, 273 units, if I'm not mistaken. From that perspective, yeah, I'm not mistaken. It's 273 units, but brand new property, beautiful, beautiful, beautiful property. So this is what would have happened. So at 5% on this specific deal, this deal would have made roughly about, I'll just simplify it, about 2.3 million a year times 10 years, because that's the hold on these type of deals. So you'd have made $23 million, 23 million on your money. That's 50% of your money. This is what all investors are looking at. Hey, if we just get this deal and wait, and we got 5% return on our money while we sat and we waited, we make half of our money back in 10 years. That's number one. I'm always looking at that. So when you're thinking through investing, and we all collectively put our money together for this deal, we were looking to hit 5% over 10 years. We can expect to make 23,000 on our 46. That's how that deal was going to walk, period. Now, we can't assume over a decade, right, that rents aren't going to continue to go up, especially in a property like that. A property, A plus plus location. It was like a 97% walk score. The location is irreplaceable on that specific deal, and it was built in 2023, if I'm not mistaken. Um, Yeah, 2023 was finished and it was already kind of leased up. So from that perspective, now we had, let's say that we increased the rent by 5%, the increased rent. So we got another, what, 2.3 million times, and let's say we didn't get it for all 10 years. Let's cut it back. We only, instead of 10 years, we only did it for 5, right? So we only got it for 5 years. So with that, that's about 11 million. That's 11.6 is what it worked out to be had we did all that. So now we have 23 million plus 23 million plus 11.6 works out to be like $34 million. So we've already made 34 million of our 46 million had we went in on this deal. This is how this deal would have worked out, right? So in 10 years, we would have made $34 million just in cash flow. Cash flow just at the 5% and the increased income, which is raising the rents by only 5% a year. Now, the thing about that at 116 million, which is where they closed, where's my phone? At 275, because the rents in this place, again, this is a best in class asset. So 116 million divided by 273 units. That's about 424,000 a door right here. Now the rents in that unit, rents in that place on the average were already at 4,000, right? 4,000, a little higher than that. So they're already around about the 1% rule on an almost brand new asset, literally less than I want to say it was kind of started in like 2018, somewhere in there, and it finished up around 2000. It took a little while to build. So, anyways, this scenario we would have made $34 million of the $46 million invested back. Now, here's the thing. Knowing that the goal here is to get paid to wait, right? So while we wait over the 10 years, this is a long-term investment. This is an institutional quality asset, 273 units. It costs 700,000 a door to build it. So right away, you're under that about $250,000 a unit based on what I just showed you, right? So when you go to sell a deal like this, you would have made, what do we say? You already made your 34 million. So 34 million, right? That was the cash flow while you waited. Plus, you still got the 46 million that was invested, like as a group. We all came in and invested that. So we still got that. That's not lost. This is preserved capital, is what that's called, right? Because we got the loan for the rest of it, and now we have our 46 million investment. Then when we were to go, like if we were to go to sell this thing, we wouldn't sell it unless we were going to make another 46 million over the top, right? So how many, if you're watching this is the way that these guys think. They're like, okay, look, in 10 years, rents are already raised. We've already hit these markers. Do we think that we can sell for 116 million plus just another 46 million over the top of that? 162 million. Even if you were to take that and divide that by 273 units, right? 500, yeah, 593,000 a door. You're still less than what it costs to build it. Because if it costs anywhere between 650 or so to 700,000 a door to build it, and 10 years from now, you're still below what it would have cost to build, you're still in good shape. So, that's it. So now we got what? That's 34 million, 34. I'll just keep it simple, plus 46 that we got. So we're getting our money back, plus another 46 million, puts us at $126 million. Right. So we made 126 million. So our 46 turned into $126 million when it was all said and done. Right? Yeah, that seems like light, don't it? That seems light. Let me redo that. So we got 46 plus a profit of 46 plus the 34 million that we made. Yeah. Yeah. So this is really how this is done, guys. When any investment that we're looking at all the time, I'm like, hey, look, and this is probably about 275%. So if our $46 million on that specific deal, we got paid $34 million while we waited, right? With professional management company, A plus location, irreplaceable location, A plus plus location, and we were below replacement costs. Again, what did I say? I think it was like 150. It would cost 156 million right, like right off the bat, where we know we need it to be. Um, but this is how much we would have made. So our 46 million turned into 126 million dollars. That would have worked out to be a 27.5% internal rate of return. That's not including the tax benefits, anything like that that would have came around with this investment. But when I saw this, I knew this was a good deal. I was like, dude, this deal is a great deal. This is a great opportunity now. What I should have done was stick and stay. I didn't know what the market was going to continue to do, but I definitely reached out to the brokers. We talked quite a bit. I went to the property, we did the offer, and we came in short. And they're like, "Hey, Vic, we have a couple of other groups in front of you at 120, 122." We did the soft quotes on the debt. Debts didn't really work out, so we were like, "Hey, here's where we got to be, 117." They were like, "No, let's wait." Then it got pulled, came back to market. The new group got it. This is what it traded at, and I could kick myself in the ass because some of the best deals you're going to do are the ones you missed. I should have been following up like nuts, but I wanted to share with you guys why I knew it was a good deal. Why? Dude, I knew 100% that we're going to make, because this group's going to do this. We're going to make $126 million on our $46 million. That would have been a massive, massive score for me and my investors. But this is what we're doing. But when what you guys see me go over this all the time. Hey, can we make 5% return on our money? Is there an increase in income that we can look at? And then based on that increase in income, how much can we exit the deal for? Can we double what we had in it? Double or triple? Now, the better thing to do in this situation is to go back to the lender because let's see, to go back to the lender on this deal, and I won't go through all of it. But what we would have done was go back to any lender and say, hey, would you refinance this deal? Right? We would have taken our 46 million on a refi cash out, out. We would have had no more money in the deal. That would have went back to the investors. And then we would have just stayed in the deal itself and cash flowed and held on to the deal. Even though we had no more money in the deal, which turned into an infinite return. And then later when we go to sell, we'd still look to double. But we got our money out. And that would have been a non-taxable situation because when you refinance and you take your money out, that's a non-taxable event. So we would have all got our money back out and we would have still owned the asset. And that asset would have still been cash flowing to us while we would have still waited and we would have de-risked the deal because we had no more investment in the deal. So that deal would have been a killer deal. There's tons of more deals out there like that. I'm on the watch for all of them, and I'm on a watch list with our brokers because they know what we're looking for. But for you guys as my investors, this is what I do. Now, if you're confused by this, I got it. A lot of people are like, man, you go so fast. Look, reach out to us. Go to bell-capital.com. Go there and just put schedule a call. We'll spend 5 minutes on a call with you, or long as you want to spend on it if you are interested in investing. One, you got to be accredited. You got to be a good person. You got to love real estate, and you got to love long-term investing with real estate. This isn't get rich quick. This is get wealthy for sure long-term. Like we said, these deals are beautiful pieces of real estate. These aren't just rando deals. These are awesome pieces of real estate. 276 unit built by one of the top builders in the country. Cost 650 to 700,000 to develop to build it, and being able to get it for 450,000 a door, a little less than 450,000 a door, unheard of in your lifetime. So I hope this helps you get a better understanding. Look, the whole goal here is how do you make sense of an investment? This is how I do it. I make sure we're buying it right. I mean, none of this works without the best asset you can get your hands on in the best location in the best cities. None of that works. This right here, non-issue. The biggest part, how do you make sense of the money? The 40% down, 5% return, the increase in income, as well as how do you exit the deal? Can we double what we had in it? Can we refinance and pull out our money and hold on to the asset and then double and triple later to get an infinite return? That's how I make sense of every deal. And if I can't hit these numbers, I'm like, yeah, we're not interested. Right. So I hope this helps you guys. Go to bell-capital.com. You can schedule a call or you can hit get started and you can register your account there. You got to be accredited and you can take a look at any deals that we're working, any open stuff that we have. If you have questions, we're here for you. Like this video, share this video, comment on the video. I definitely want to help you. But you're going to see me go through this all the time. It's not, this is how we are playing the game because we are working with institutional quality assets. And I want to help the everyday investor get into these deals. These deals are not available to just everyday people. Everybody who looks at these type of deals, the deals we're looking at going after, they're institutions or they're groups that are partners with institutions, banks, pension funds, sovereign funds. That's the people that we are playing against. And I want to play that game with you rather than me go to institutions and banks and stuff like that to raise the equity and partner with them. They're already wealthy. I don't want to feed that wealth machine. I want to help you guys. I want to help the everyday investor like you, like me, the hardworking person, the entrepreneur, the business owner. That you're my people, man. And I appreciate you guys. So like again, like this video, share this video, comment on the video. I love your comments. I'll make more videos on this, going over how we underwrite our deals, why we look at the way that we do. This isn't underwriting the deals, this is underwriting the returns, right? This is what I do. And I would love to talk to you guys about that, share more about it with you guys, and get you involved in what we are doing as an investor because I want to go to work for you guys. All right. So you guys have a great day today. Let's get after it. Go.